So we've built our model of aggregate supply and aggregate demand. We have a downward sloping aggregate demand curve, an upward sloping short run aggregate supply curve, and a long run aggregate supply curve. You'll notice on the graph we have these three lines, and a long run equilibrium will occur where all three lines intersect. So here's our initial long run equilibrium. And we want to start to think about how different events will affect the economy. So we're going to start by thinking about long run growth and decline, or shifts in the long run aggregate supply curve. So think about what could happen that would shift the long run aggregate supply curve. And remember that long run output is equal to a function of our inputs and technology, efficiency, and productivity. So only changes in one of those variables will affect long run output. In these types of problems, usually I will give you an event and I will ask you what will happen as a result of that event. In this example, we have a hurricane that causes extensive flooding and damages in Houston, and I want to know how that's going to affect the economy in terms of this model. The hurricane has damaged factories, roads, houses, all sorts of things within the economy, which is a decrease in capital. The hurricane destroyed capital stock, and that will lead to a decrease in long run potential output or real output. Now, when we say long run, we don't necessarily mean that that's going to last for a long time. Is Houston damaged for 100 years? Probably not. They can rebuild. What we mean is that our real productive capacity is declining. So that leads to a decrease in long run aggregate supply. So long run aggregate supply will shift inward. Here's our initial level of output and price level. And when long run aggregate supply shifts inward, short run aggregate supply will move with it, because short run aggregate supply just represents how we would deviate from our long run potential when prices are different than we expect. So because now we have a new long run potential, the short run aggregate supply curve showing those deviations will shift right along with long run aggregate supply. So when we shift long run aggregate supply, the short run aggregate supply curve will move right along with it. Right, so we get to a new equilibrium point. So I'm going to label this point A, our original point A, and then our new point where our long run aggregate supply curve intersects our aggregate demand curve. That's going to be our new long run equilibrium. So we have here a decrease in output and an increase in prices. And again, just because we're calling this long run doesn't mean that this has to happen for a long time. I think that can be confusing for people. What it means is that here we have a decrease in output, not due to a market imperfection, but due to a change in our real productive capacity. Now, as Houston rebuilds, they will probably regain productive capacity, and long run aggregate supply would again shift out. So just want to make that distinction here before we move into our short run aggregate supply shock and aggregate demand shock examples. This is an example of economic decline due to some event that affected our real productive capacity. We can also use this model to think about economic growth. Say we invented a new technology. That's going to shift the long run aggregate supply curve outward. We're going to get more output and lower price levels when we have economic growth in the long term. And that long run economic growth, that's really one of the primary goals of society, is to maintain economic growth in the long term, whether that's say 2 or 3% a year for the US, that we're improving our quality of life over time. In the next video, we're going to start to look at short run business cycle fluctuations. Again, we're drawing this distinction between long run economic growth and short run business cycle fluctuations. And that is the primary motivation behind this model, to look at why we see these big fluctuations up and down, up and down, up and down along our long run rate of growth.